Now, our other top story today has to do with financial stocks. Banks getting a big boost today because the Federal Reserve giving them all the clearance. This is the 19 largest banks to resume dividend payments to their shareholders, as well as to initiate share buybacks. JP Morgan Chase, as well as Wells Fargo, both increasing their dividends following the announcement. Goldman Sachs says it's going to buy back the $5 billion worth of preferred stock that it had previously sold to Warren Buffett's Berkshire Hathaway. So for more on this story, we're joined now by Todd Harrison. He is the founder and chief executive of Minyanville Media. Todd was a partner at Kramer Berkowitz. He's also worked at Morgan Stanley. Also with us, we have Anton Schutz. He invests in financial stocks as the president of Mendon Capital Advisor. He knows a thing or two about banks. Let's start with you, Anton. Not unexpected. So does this mean we just get more dividends coming for the rest of the year?
We do indeed. JP Morgan clearly had the most capital and the most ability to generate it, and they gave us the biggest pop in terms of buyback. And dividends are going to ramp up a little more slowly, but clearly have the ability to do so themselves. The rest of the industry is going to start increasing dividends in the second, third, and fourth quarters, with Citibank being sort of one of the lone holdouts, talking more about next year. However, if they get to shrink the bad bank at Citi, there's a potential for them to, come to market as well and give us buybacks and dividends.
Well, Todd, I'm glad that Anton mentioned this idea of the bad bank at Citi, because one of the things that has helped the banking industry is they got to move a lot of those bad assets off their balance sheets. There was a lovely accounting change that happened. What's the future of that accounting rule, and what does that mean for the future of the health of the banks?
Well, you hit the nail on the head, because I think it's a tale of two tapes right now. If you remember, the whole reason behind TARP was to reflate the markets, to give the banks the ability to roll their debt and to issue more stock. And
some breathing room, right?
Some breathing room. And that's been largely achieved. And also the action in 2008 was very much capitulatory. So a lot of institutions are underweighted in the banks, so this will presumably give them a little bit more of a risk appetite for the sector. That being said, the accounting rule you're referring to, FASB 187, was one of the catalysts that was opaquely responsible for the financial crisis in the first place, that would call for them to move their level 3 assets back onto their balance sheets. That's been quietly pushed aside. So if that comes back, then you're going to have a lot of the same insolvency issues, I think, for a lot of these institutions. But right now, that's hush-hush, tucked in a corner.
Anton, what do you think? Changes to accounting rules?
Well, changes to accounting rules, yes, perhaps. I think that's true. However, the value on those very securities that caused a lot of, this crisis really had to be called into question in many ways. Perhaps the banks were overstating them at first, but when Merrill Lynch was selling these for 22 cents on the dollar, that was understating them.
All right,
so
we're going to continue the conversation. Anton, we're talking about accounting rule changes, and I just want to toss in this notion that interest rates very low, so that means inexpensive money for the banks, and also the banks have had time to work out some of their problem loans, and we've seen credit metrics, the fancy word for just the state of the credit market, has done very well over the last 2 years. So what's the future for the health of banks, and is it too late to buy bank shares?
Not even close to too late to buy bank shares. If you think about the types of multiples, the earnings and dividends they can generate, it's pretty substantial. If you think about what the Federal Reserve has done in bringing rates down, they've certainly stimulated the economy, and that's much more important for the health of the banks than necessarily the absolute level of rates. For instance, banks that lend on variable rates, i.e. LIBOR and Prime, aren't earning a lot on that. The deposits, they can't push down very much more. So actually, a lot of banks are asset sensitive. They'd actually make some more money if the Fed gradually, increased short-term interest rates. However, the health of the economy is really what's tantamount to the health of the future of these banks.
Now, let me come to you, Todd. So as Anton says, the health of the economy, much more important than whether we're going to move items from one side of the balance sheet to the other, whether the banks are going to, raise rates on commercial loans. The health of the economy is what's going to be fundamental. Do you agree with that?
Well, I do. And I think much like we talked about the banks and the accounting rule, we can also talk about the economy and the synthetic stimulus that's been injected. How healthy is the economy? If it wasn't, if it didn't have this government crutch, much, it's a different conversation, but it does. So we have to play the hand that we're being dealt. But I think to his point, it's very much true in terms of the banks. It's a function of time horizon. Credit markets act great. So that's the bull case. I think the bear case, however, is that as the crisis shifted from the financial to the economic to the social spheres, we're seeing that play out in real time. We saw it from the financial crisis. We saw the sovereign sequel last year with everything that went on overseas. And now we're seeing it in the Middle East, in the geopolitical spectrum. And you have to ask the question, well, what if, Egypt was Fannie Mae and Bahrain and Yemen or Tunisia were Freddie Mac? What's going to be the Lehman Brothers in that equation? I think that's the risk. It's more socioeconomic than it is tangible at this point.
All right, Anton, come in on that. I mean, is there really a case to be made to connect the global events that we seem to have to deal with on a weekly basis, whether it be unrest in the Middle East or natural disasters in Japan? What effect is that going to have on bank shares? Or have banks been beaten up so much that this is just look at the book value and look at interest rates and move ahead?
Well, I mean, I guess I could spend the rest of the night on the show talking about this. But if you really think about it, the world has really become interconnected. And it's about economic relationships to each other. And clearly, oil has become a very, very important factor in how well an economy is doing or how poorly it can do if there's undue pressures on the price of oil. So that's, certainly from a socioeconomic perspective, that's huge. The level of interest rates, I mean, the central banks are doing a great job. I mean, one could argue about whether they're overdoing it, but I think they will not let a Lehman happen again. I think that's very important. They will respond much quicker, and they will absolutely not let a failure like that happen. So I'm not sure I could say Egypt is the next Lehman. Clearly, Japan spooked a lot of people. It's the third largest economy in the world. So the world is interconnected. However, banks have much higher reserve ratios and lots more capital. They've raised $500 billion of capital in the banking system in capital raises. So they're much better shape to absorb anything that comes down the pike.
Todd?
Well, I would say that's in this scenario, respectively. I think that potentially Saudi Arabia or Iran would be Lehman Brothers if that analogy played through. But to his point,
because then that connects to the economy, because you're going to see oil increase in price.
Contagion is just an amorphous reality in this world, and it's taking many forms. But the reason I think that the dollar-yen relationship is so important, and to talk about the interconnectedness of the market, the carry trade is a very crowded trade, and the correlation in the marketplace among hedge funds and institutions that have the carry trade on, when you see these currencies...
Now, the carry trade being able to borrow money in a very low-cost currency like the yen, and then go and do something with that money, maybe buy riskier assets that are going to give you a little bit more pop.
Yes, and the correlation in that trade is very high, and the leverage in the system remains very high. And it's still, despite everything that's happened, it's still a very opaque market. There hasn't been that much regulation that's come through. So there is a domino effect that could happen, that could conceivably happen from a currency effect that I think people need to appreciate, even if they don't fully understand it.
Anton, come in on this topic of people borrowing in low-cost currencies and then speculating. Is it possible that if we see any increase in the price of oil, that's going to worry people about inflation, and that's going to make everyone run to the Treasury market? What would that do to bank stocks, do you believe?
Well, believe it or not, banks are huge holders of treasuries.
Indeed.
And lots of fixed income instruments like agency securities as well. So, I mean, to some extent, it would actually drive book value higher to the banks. But, last thing we want to do is destabilize an economy or create a lot of panic. And there's no doubt that the market has a healthy respect for the global events, as we saw earlier in the week with how the stock market reacted. However, if you really think about it, the stimulus is tremendous. The ability for all the nations to try to prop up currencies, it's short term, but it's real, and the speculators have got to be careful about it. Certainly, some speculators got severely hurt this morning by the intervention. So, I'm not a fan of that type of activity. I hearken back to long-term capital management and how all things correlate when they go the wrong way. So August of 1998 is still fresh in my mind. People have to be careful.
All right, we got to leave it there, but I want to thank you very much. Anton Schutz coming to us from Mendon Capital Advisors in Rochester, New York. And I also want to thank Todd Harrison from Minyanville Media, also the author of the new book, The Other Side of Wall Street. In business, it pays to be an animal. In life, it pays to be yourself. Still